Good morning. It is Friday, March 21st. Congratulations to all of us. We made it through another week. I wanted to highlight real quick part of the message that came out from the Fed. They held interest rates constant, as everybody knows. But a little snippet here, this little part of a paragraph here. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Beginning in April, the committee will slow the pace of its decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from 25 billion down to 5 billion. That's significant. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at 35 billion. So when we start to get into trouble and the Fed is really worried about recession, they will stuff liquidity into the system. And they do that by building their balance sheet out with additional treasuries that they buy with money that didn't previously exist. Lots of arguments as to whether or not they're actually creating money. Certainly they're not printing money, but they are forcing liquidity into the system. Well, you can only do that for so long, and so when things start to get a little bit better, they start pulling some of that liquidity back out. They do that by reducing their balance sheet. They do that by buying back some, or selling, I should say, some of the treasuries that they previously put on their balance sheet. What this is indicating is that they are worried about the economic recovery, and so they are slowing the rate at which they are bringing us back to a more normal situation. So to me, more than the words, this is some actual action. They didn't think that they needed to take action on the interest rate, but this is a step of taking action to ward off a recession. Good luck out there. Talk to you soon.